Imagine waking up tomorrow to see silver prices drop sharply, wiping out weeks of gains. But while most investors panic, a small group of smart investors seize opportunity. What if everything you thought about this crash is only half the story? Today, I'm going to show you exactly how strategic investors interpret a silver crash, why they act differently, and what the market is really telling us. Insights most people completely miss. By the end of this video, you'll see the silver market through a lens that very few retail investors ever consider. Before we dive in, this video is for informational and educational purposes only. It is not financial advice. Markets are volatile, and past performance is no guarantee of future results. Always conduct your own research, consult qualified financial professionals, and only risk capital you can afford to lose. Protect your capital. That is the first rule of investing. Imagine waking up today, February 11th, 2026, to see silver prices down sharply from their January peaks near $121 per ounce, wiping out weeks of explosive gains in a matter of days. Headlines are screaming crash. Retail investors are panicking and selling. But while fear dominates the surface, a smaller group of disciplined strategic investors is seeing something very different. A potential setup for the next phase of this multi-year bull market. Today, I'm going to walk you through exactly how experienced investors are interpreting this correction, why the fundamentals remain intact, and what the market is truly signaling. By the end, you'll understand the silver market through a lens that most retail traders never consider. The silver market has been one of the most explosive and volatile stories in commodities over the past 18 months. In 2025, silver surged more than 130 to 150% from around $30 to $40 levels, driven by massive industrial demand, persistent supply deficits, and waves of investment buying from both Western and Asian retail investors. It hit an all-time high near $121.88 per ounce in late January 2026. Then came the violent correction. On January 30th, following the nomination of Kevin Warsh as the new Federal Reserve Chair, viewed as more hawkish on inflation and supportive of a stronger dollar, silver plunged over 26 to 31% in a single session, one of the largest one-day drops in its history. Prices tested as low as around $75 in early February before rebounding. As of today, February 11th, silver is trading in the $83 to $85 range, up several percent in recent sessions, but still well off the peak. This wasn't a fundamental collapse. It was a classic deleveraging event in an overextended market. Why the sharp drop happened? Let's break down the mechanics. The primary driver wasn't vanishing demand. It was leverage and positioning. Silver's parabolic rise in January attracted heavy speculative buying, including leveraged futures positions, call options on ETFs, and retail inflows from India and China. When the Warsh nomination strengthened the US dollar and shifted rate cut expectations, it triggered profit-taking and forced liquidations. Margin calls cascaded. High open interest and stretched momentum indicators meant even moderate selling snowballed. Retail panic amplified the move, as it always does in leveraged markets like silver. No circuit breakers existed to slow the descent, making the drop more severe. Importantly, underlying industrial demand did not disappear. Silver remains critical for solar photovoltaics, electric vehicles, electronics, and increasingly AI data centers due to its unmatched electrical conductivity. Most retail investors react emotionally to the chart. Price is crashing. I must sell. Or, the bull market is over. They focus solely on the daily or weekly candle and ignore time horizon and structural trends. Here's the critical distinction. Silver has a long history of sharp corrections within larger bull cycles. The 2011 spike to nearly $50 was followed by a brutal pullback, yet those who understood the macro and industrial story eventually saw strong recoveries. The same pattern is playing out now. Mine supply is inelastic, mostly a byproduct of copper, lead, and zinc mining, and new projects are limited. Industrial demand strength. Over 60% of silver demand is now industrial. Solar installations, EV production, including charging infrastructure, electronics, and AI/data centers, continue driving consumption. This correction is recalibrating an overheated market, not signaling the end of the secular bull driven by deficits in green technology. What strategic investors are doing. Experienced investors ignore the noise and focus on data. They track persistent supply deficits. 2026 marks the sixth consecutive year of structural market deficits, projected around 67 million ounces by the Silver Institute. While some thrifting, using less silver per unit, is occurring, overall fabrication demand remains robust, with forecasts showing steady or growing needs through the decade. Short interest and positioning. Elevated short interest in silver miners and futures creates potential fuel for short covering if prices stabilize. Mining margins. Even at current prices around $84, many producers maintain healthy margins, supporting future supply discipline. Smart money is often accumulating physical metal, quality miners, or related equities on these fear-driven dips, while managing position sizes carefully. The biggest difference between panic sellers and professionals is disciplined risk management. Strategic investors. Size positions appropriately to survive volatility. Diversify across physical silver, miners, and related assets. Monitor correlations with gold. Current gold/silver ratio around 60:1 after compressing from higher levels. Track macro indicators. Federal Reserve policy. Funds rate held at 3.5% to 3.75% in January 2026. U.S. dollar strength, inflation trends, and global growth signals. They treat corrections as normal breathing room in a bull market, not reasons to abandon the thesis. History rhymes. The 2011 boom-bust in silver was followed by multi-year consolidation and eventual recovery as industrial uses grew. Today's setup is more compelling because of the structural supply deficits and the explosive growth in solar, EVs, and AI, sectors that barely existed at scale in 2011. Human behavior, leverage cycles, and macroeconomic forces create these repeatable patterns. Institutions often act counter to retail emotion. While headlines focused on panic selling in late January and early February, behind the scenes, many hedge funds and long-term players used the dip to add exposure, anticipating short covering and a return to fundamentals. This perception-reality gap is where alpha is generated. Silver's dual role as both a monetary metal and industrial commodity makes it sensitive to macro shifts. A stronger dollar, post-Warsh nomination, and higher real yields pressured prices, but easing expectations, inflation hedging, and global industrial growth provide support. Gold has held up better as a pure safe haven, currently above $5,000 per ounce. But silver's industrial leverage often leads to outperformance during economic recoveries and technology booms. Looking ahead, three realistic paths emerge. Best case, stabilization leads to short covering, industrial demand accelerates, and higher real yields pressured prices, but easing expectations, inflation hedging, and global industrial growth provide support. Gold has held up better as a pure safe haven, currently above $5,000 per ounce. But silver's industrial leverage often leads to outperformance during economic recoveries and technology booms. Looking ahead, three realistic paths emerge. Best case, stabilization leads to short covering, industrial demand accelerates, and silver rallies strongly within months, potentially retesting higher levels. Worst case, further macro shocks, for example, unexpected dollar strength or liquidity crunch, drive another leg lower before the floor is found. Most likely, base case, continued short-term volatility and choppiness around the $80 to $90 zone, but the structural deficits and demand trends remain intact. This rewards patient, well-positioned investors over emotional traders. The silver crash of early 2026 is a textbook example of how leverage and sentiment can create temporary dislocations, even when the long-term fundamentals are stronger than ever. Smart investors don't fight the volatility. They prepare for it and position around the real story. Chronic supply shortages meeting unstoppable technological demand. If you found this analysis helpful, drop a like, subscribe for more in-depth market breakdowns, and let me know in the comments what aspect of the silver market you want covered next. Remember, this is not financial advice. Do your own research, manage risk, and protect your capital. Trade and invest responsibly. Thank you for watching. Stay informed, stay disciplined, stay